Well, because of the failure of the Build Back Better legislation last year, the federal estate tax remains a non-concern for the vast majority of people. However, for some larger farming operations planning to avoid the full impact of the tax, it is very necessary. And Roger McEowen with the Washburn School of Law joins us now to review a tool for estate tax planning. Roger, thank you so much for being here. Now, one aspect of the estate plan might involve the use of an intentionally defective grantor trust. And explain how this works.
Well, good to be with you, Suzanne. An IDGT is an irrevocable trust that is designed to avoid any retained interests or powers in the grantor that would result in the inclusion of those assets in the decedent's estate or the grantor's estate at death. Now, normally, an irrevocable trust is a tax entity that is separate and distinct from the grantor, and so it has its own income and its deductions, net of the distributions that are paid out to the beneficiaries. And it would have to report all of that on its own income tax return. But the beauty of an IDGT is that there's language that we draft into these types of trusts that causes that income to be taxed to the grantor, but at the same time, it's effective for estate tax purposes, and it keeps the value of the assets that have been transferred to the trust out of the grantor's estate. So it's defective for income tax purposes, it's effective for estate tax purposes.
So really, this is so important for so many various reasons, but ultimately to save the grantor some money and make sure they are able to transfer the property.
Yeah, what you're doing is if you've got highly appreciated assets, such as farmland that might be located near an urban area, so it's the upward price pressure is substantial, or maybe we have economic conditions that are pushing that land value up. That's typically the number one value in a farm estate. So we transfer that into the trust, and that further appreciation accumulates inside of the trust, free of gift tax, free of generation skipping tax, and it's not in the decedent's estate at death, so it's free of estate tax. And that's a big deal for large estates, and that's going to be an even bigger deal if Congress ever decreases the exemption from its current level of $12.06 million. And keep in mind, if Congress does nothing, it goes to $5 million starting in 2026 with an inflation adjustment. So it basically would be cut in half.
I mean, obviously, a lot of pros. What are the cons of IDGT? Are there any?
Well, it's incredibly complex, and you have to make sure you have enough cash flow as the grantor so that you can pay the tax on the income generated by the assets in the trust. And you have to make sure you have enough assets to fund the trust, or we can get into estate tax problems that way, as well as income tax problems. So this is really only for the very large operations. And again, that could be redefined if the law changes and that exemption comes down.
So when passing on a large farm operation to the next generation, and I know folks are watching on, hanging on the words of this, first steps for the grantor, the seller, to take when looking to use IDGT.
Okay, it's going to work for you if you have family business assets that are appreciating highly in value, and you have heirs to which you want to shift that appreciation and asset value that are interested in continuing the farming or ranching operation into the next and subsequent generations. So again, it's restricted to high value operations where we're looking to transfer the business to the next generation. But any key drop in that exemption, I'll reemphasize this, if Congress does nothing, it's going to basically be cut in half starting in 2026. So we'll see what happens. This is highly technical. You really need an excellent practitioner that can put this together for you if you're interested in it.
Roger, thank you so much for this insight. That is Roger McEowen with the Washburn School of Law. We appreciate you joining us.